Hi, and welcome back to UncoverFraud.com. My name is David Melamed, and I'm a forensic accountant and fraud investigation expert. Today, I want to talk to you about franchises. Specifically, I want to speak to you about Chick-Fil-A franchise. As well, I'm going to speak to you about franchise fraud. So if you're ready, let's go. First of all, Chick-fil-A is on the scene. When I talk about on the scene, they are a fabulous, fabulous company that's going to be in the top 3 fast food chains in North America. Right now, they've got over 2,000 locations. And, if you're thinking about being a franchise owner, this is really a different kind of setup. And when I say it's a different setup, what they want upfront from you is $10,000, and they pay for the construction fees, the leases, the leaseholds, building the place, and really what they're looking for you is for leadership. Now, getting a franchise is not that easy. There's about 75 to 80 franchises that are approved a year, and there's over 20,000 people that apply. Quite different than a McDonald's that requires you to have liquid assets of $500,000 plus, and really you've got to have enough money to pay for building or putting together a new McDonald's. Let's get back to Chick-fil-A. So Chick-fil-A, fabulous franchise. However, there are certain things that as a franchise owner, you need to know. And one of the things that you need to know is that this franchise takes 15% of royalty, 15% royalty from the top. That means your gross sales, meaning everything that you've sold, they are going to take 15%, and then they take 50% of profit. Now, that's the trade that you make for having that low upfront cost of $10,000 to become a franchise owner. When you become a franchise owner, one of the things that you got to remember is that they want you focused on this business. If you're an entrepreneur, you can't have other businesses, and usually you don't get to have more than one franchise, meaning that you are operating and owning this franchise. You are there. Now, the good thing about Chick-fil-A is every Sunday, all locations are closed, and they give you and your employees some time to rest. But 6 days a week, Monday to Saturday, you're there, you're operating, you're watching what's going on. Now, in terms of the world of fraud, what I see is whenever people invest in restaurant businesses and they are non-operators, meaning they're not there, there is usually some degree of fraud that occurs. It could be fraud as simple as the order not being punched in, meaning that the person who gets cash for $20 of burgers and chicken and French fries puts it in their pocket. Or it could be that, they're using the point of sale system and diverting cash and diverting sales to themselves versus winding up as part of your gross sales. Now, Chick-fil-A actually had an issue where 2 of their employees were getting customers' money transacted into their personal bank accounts versus Chick-fil-A's account. And what happened with that is that hundreds of thousands of dollars were taken, and those people right now are indicted, and they're probably looking to somewhere between 20 to 30 years in jail, but only time will tell what it is that will happen. I've investigated quite a few fraud cases dealing with restaurants, and what I'm seeing is it's the absentee owner, the person who invests money up front to help build a place that may, add some funds along the way if the business is short cash, that doesn't know what's going on. In fact, I just had a call from a small restaurant, and this small restaurant was started by 2 individuals. One was going to be the operator, and the other one is the non-operator who funded the restaurant over 10 years ago. They put in about $75,000 to the restaurant, and the agreement was that they would split profits 50-50. Now, this individual is making cash and paying people in cash, paying vendors in cash, so the non-operator doesn't really have sight into what's going on. Not only does he not have sight, but when he looks at the point of sale system, he actually was able to identify that items are being returned in excess of $1,500 a week. And when he looks at the items that are being returned, those aren't even items that were being ordered, meaning that likely the operator is refunding sales, bringing sales down, and having to pay less money to the non-operator. Now, this individual is, not willing anymore to tolerate the fraud, so he's called me and he's asked me, how can I help? What we do is we go in and we quantify what the loss is. Once we've quantified what the loss is and where the areas of exposure are, we make a decision collectively. Is it that we're going to confront this individual and we're going to suddenly see that sales increase or spike because this individual now knows that a fraud investigator is watching? Is it that this individual is going to have a shotgun clause offering X dollars to buy out the individual or to be bought out himself? Or is this individual going to the police and pressing charges for fraud and theft? Now, I believe it probably should be a combination of two, because this individual is dealing with somebody that has taken their money. And not only taken their money, but by being a non-operator, still an investor, the lease is on their name, there is a tax liability that this individual is responsible for, and chances are there's probably an outstanding tax liability for sales that weren't recorded properly. So let's get back to Chick-fil-A. When we talk about franchises, owning a franchise is really good if this is what you want to do and you want to be an owner-operator. One thing that you got to remember is you're buying your goods from headquarters, meaning that they're setting the prices for you. You know, what I have seen some franchises do is they go out and they buy their own pop, for example. So they'll go to Best Buy when Best Buy has pop on sale, and they'll buy those cans instead of buying it from headquarters. Now, head office does not allow you to go to Best Buy and buy cans of Coke. They want to sell you cans of Coke, and they've got set prices, and their prices, factor in some profit for themselves, as well as the royalty that they're taking. And now Chick-fil-A, with their 50% profit that they take, something you should know as an owner-operator is most of owner-operators are making, on average, $4.2 million gross sales, which is significantly higher than most franchises. As well, they're making in excess of about $200,000 a year take home. And that really is the question. At the end of the day, how much money are you taking home? And, $200,000 is a lot of money, but you've really got to think to yourself, is this the commitment that I want to make? Do I have the leadership? Do I have the community around me supporting me? Because what Chick-fil-A is looking for, besides your $10,000, and that's really only a token investment, is they're looking for somebody who's got character, who's got leadership skills, who can carry the team, who will be there. And when I've seen franchises fail, the reason the franchises fail is because the owner is not an operator. They let other people direct the business, and as soon as that happens, the business isn't run the way that they want. As well, they become exposed to different types of frauds. Look, hopefully you found this helpful and interesting. Please don't forget to like it and to subscribe. My name is David Malamed, and I'm a forensic accountant and fraud investigation expert with over 20 years of experience. If you want to find out more about me and the services we offer, please visit uncoverfraud.com. Until next time, I look forward to seeing you again. God bless.